Hello, I'm Mark Lathem, and I'm a lawyer who's been practicing law in Richmond Hill, Ontario for over 20 years. And I'm often consulted by real estate agents and clients who are investing in real estate for purposes other than a house on the tax consequences of doing so. And what I remind everybody is that taxation is a way in which government can accomplish its social goals by either encouraging people to do certain things or discouraging them. And basically, if one looks at what the government's trying to do recently in housing policy, it's trying to prevent hyperinflation of real estate prices. It's trying to encourage stability in the real estate market and essentially help Canadians acquire houses to live in. At the same time, it's trying to discourage behavior which is intended to or has the effect of destabilizing the housing market or increasing the prices greatly by flipping. So when you're dealing with an investment in real estate, the investment of money in real estate will fall into one of four tax categories. The first would be the principal residence. The second would be capital property. The third would be inventory, and the fourth would be personal use property. And I've laid them out really in the order in which they're treated from favorably to least favorably for tax purposes. And the principal residence exemption is one in which the is an exemption where there is no capital gains tax will be paid on the sale of the property that a family has used as their principal residences. Now, a couple of things about the principal residence exemption. The government many years ago introduced amendments to the Income Tax Act to allow for only one principal residence per family. So the old method of having the husband own the house in Toronto and the wife owning the cottage will not work. The second piece of property will always be treated as what's called personal use property, which is among the least favorable tax treatments. The second category is capital property, and capital property is, as the name suggests, is an investment in property to generate income from the property. And I would caution you, what that means is the income is generated from the ownership of the property by activity that's occurring on the property other than by the increase in value of the property itself. So a typical example of a capital property is a rental property where it's being rented out to tenants, it's being occupied by a manufacturing business, or so on. And what happens with that is upon the sale of the property, only half of the increased value is added into the income of the taxpayer and taxed. And the third category that I talked about is something called inventory property, and real estate agents, flippers, and builders are typically dealing with what are called inventory properties. And that's property where the primary purpose is to make a profit from it through its increase in value and not how the property essentially is being used. So again, builders, when they buy a house for renovation or a lot, the investment of real estate in that manner is considered inventory. So is buying a property and giving it a makeover. It's also treated as inventory. And the other example would be when somebody buys a bunch of condos with the intention of either assigning it or selling for the increased price shortly after the sale of the property. And the consequence is that all of these, when they're sold, 100% of the profit is added to the income versus the capital property where 50% is put into the income. And the fourth category is the personal use property. And personal use property is property basically owned by an individual for their own personal use, in which it's subject to capital gain on a sale, but also because of its personal use nature, the cost of carrying the property are not allowed to be deducted on an ongoing basis. And the example would be the cottage. Now, hopefully I've given you a general overview about our income tax system and how it deals with these things. I think in the investment of property, it's important to understand the tax consequences of particular forms of investing in real estate. And I can give you an example of where a little bit of thinking can change the tax categorization of property from one that is not so good to slightly better. And I'm going to use two examples. One would be the cottage, and the other one would be the buying of condos with the intention of flipping. The common thing done with cottages, which are secondary residences, is they are turned into a rental property for part of the year, thus allowing interest and carrying costs to be deducted. And when they're sold, they're still subject to the capital gains, but it's a slightly better tax treatment than the scenario where the cottage is simply personal use property. And let's take the example of the condominium. A person who buys 5 condos for the purposes of flipping them is going to run into a number of tax issues. Number one, if they're flipped, they're going to be subject to additional HST of about 8%. In addition, the capital gains will be fully taxable. Take those same properties, or let's say buy only 2 condos, rent them out for a couple of years and then sell them, you're going to be eligible for the HST rebate, and the tax that's paid on the property will be capital gains and taxed at 50% of the gain versus 100% of the gain. And you can also manipulate your income to a certain extent by selling those condos at a time when your income is at the lowest. So these are the advantages really of understanding the tax system. And a word of caution, what we have found in the number of years, particularly the last 5 years, is that effectively Revenue Canada has become much better at reading the many available electronic records when it comes to tax. So we find that Revenue Canada is able to identify transactions in a way that 5 years they could not. They're able to look at all of the land records to determine the patterns of ownership that people have, and they have been known to compare those records to people's income tax returns where their driver's license listed to see whether they believe the taxpayer with respect to the position they've taken. Now, this is but a very short presentation on a lengthy one that we are going to be preparing in the next 6 months. And I hope that what I've said assists you in some understanding some basic rules about tax and real estate. And should you find that you need our services, of course, we're prepared to work with you and your accountant to assist you in making the appropriate decisions with your real estate investments. I thank you very much and have a nice day.